late. I'm here. What are you talking about?
We're here. we're here. Ladies and gentlemen, welcome to the SoFi Weekly Podcast. Today is a very special day because finally SoFi has had a very exciting week. And although Steven has a headache, he still has a lot of energy behind him. And we are going to see a lot of macro Steve here. So, yeah. How are you guys doing, first of all? Steven?
Oh, I got a bone to pick with you.
Is it something that you want to address publicly?
I'm sure, even though it was in a private message, sure.
Oh, well, I don't know if I want to. if
I
it's
mean,
allowed
what
to be
you
public,
asked
then-
Tevis and myself is a little crazy.
What?
What you asked Tevis and myself is a little crazy.
What did I ask of you?
Go back and read maybe, 10 messages ago.
On Twitter?
Well, Senor Musk would prefer you call it X.
Sorry. I don't know.
Is it the drinking thing?
No.
Oh, the FedWatch tool?
No. Oh my God.
I'm just scrolling up our chat. Steve, you're so cryptic.
Yeah.
The edit.
Paying for
editing?
shorts?
Oh, the editor.
Yeah.
That was Tevis. Tevis asked that, not me.
Oh, I thought that was you, Tanner.
No. Pick a bone with him, not me.
Oh, I got a bone to pick with you, Tevis, then.
Yeah.
I said no.
I do all this pro bono.
I know.
That's not my obligation, sir.
You think I'm getting a salary from this?
What? I'm just saying, I do this pro bono. That's not my obligation, sir.
All of the viewers on chat are readers on your Seeking Alpha page, okay?
First of all. Second of all.
First of all, I'm not running a YouTube channel that benefits in any way from this.
Actually, now that we brought the Seeking Alpha into it, you're probably the one that makes the most out of all of us, Steve, from content creation specifically. I don't know what you're saying. I have 20 viewers on my channel right now watching this thing. I'm not rolling in it, dude. We all do this pro bono.
Okay. Now, before we jump into some SoFi news, I got one more bone to pick.
Yeah, so
Steven,
let's do this. Jan 1 to December 31st. Let's go.
You see this little tricky thing that he's trying to play here?
Because, hold on. You're cherry picking data and information. So you want to make a bet, define the time frame, and we can make a bet.
Yeah, the time frame was whenever we spoke about the thing, which was October 13th, 12 months to October 13th. Now, this is what we're all talking about, by the way. So I tweeted this out saying that there was a SoFi Weekly episode that we had where we were talking about block versus
when was
Palantir.
the episode?
Sorry?
When was the episode?
October 13th.
What year?
2023. What?
That's like 2 freaking months. You're cherry picking information. It's 2 months.
Yeah, I know. Okay. I know that 2 months is not a long time. You said
we never defined how long.
Yes, we did. We defined 12 months. I'm just saying.
Okay,
so far,
12 months. So you're 2 months into a 12-month thing. Talk to me in 10 months from now. Next.
No, I know.
Next.
Listen. You said in the Twitter thing, whenever I posted just 2 months, I know.
Yeah, if I want to make it interesting, yes.
Yeah, you said, do you want to make it interesting? But you don't want to make it interesting from October 13th. You want to make it from December, whenever the stock has already ran up 70%.
Listen, I'll stand by it. That's fine. We can go back and give you a head start. No problem.
It's not a head start. It's from where we.
It is a head start because now we're going to make a bet after data has already come out. But I'm fine with that. No problem. No problem.
You still think?
What are you guys betting?
Think that in 10 more months that Palantir will do better than Square?
Yeah, because I think Square's going to come down.
What are you guys betting?
What are we betting, Steve?
What charity is it going to, Steve? Is it going to the charity of Tanner or Steve?
Yeah, no, I don't want any money from Tanner, so it's got to be for charity. I don't want to do anything. I don't need the benefit from this personally. So.
But you want to do Christmas gifts, so why don't we just do something
but that's a wash.
Yeah,
I'm not benefiting personally from it because it's a wash. We're all doing the same monetary value.
Yeah,
that's fun. I don't care about your bets for the Christmas.
Okay. Anyway,
All right, we'll figure out the monetary offline.
yeah.
But yes,
Okay.
we can make a bet and you can be ahead, no problem.
Because you said you wanted to redefine the terms. I was like, what are you saying? That once you get a 70%.
You think I remember how long I can't remember shit from last week. Come on.
Fair enough.
I'm going to start a poll in my chat asking people.
Okay. SoFi and the rest of the fintech companies have had quite a large run up. All right. This was mainly due to one very exciting FOMC meeting, which Stephen is going to talk about, which boded very well for the idea of rate cuts. But Stephen, why is that important? And why would a company like SoFi benefit?
So
hold on. Can we talk about what happened in the FOMC meeting?
I'll preface what happened, and then we can get into it. So the very short version of what happened is our wonderful chairman, Jerome Powell, and the rest of the cohort of the Fed saved the holiday season. And they did not say that they are cutting in March. Let's be very clear. They did not say that.
Correct.
What they said is unemployment came down, growth is slowing, and that the door is open for another hike. But based on the individual assessment that each of the Fed members took, the consensus is that rates will end up at 4.6% in 2024, 3.6% in 2025, and 2.9% in 2026. If the Fed stays on those targets, is a completely different story. But they're basically baking in 75 basis points worth of cuts in 2024. And based on what they have currently done, logically, it would seem there would be 3 25 basis point cuts at some point. They could do a 25 and a 50, a 75, however it is, but they could go up in the short term. But even if they were to go up at the January meeting, it would be short-lived. It would either be at 60 or 120 days. If we go to Fed Watch tool, we can bring up the probabilities. I'm sure they have been moving quite a bit since the meeting. So that's where we are on it. Now, it's important for a number of reasons. First reason is cost of capital becomes cheaper. Businesses are more likely to expand. Businesses and individuals are more likely to make big purchases when rates come down because financing is going to be much cheaper. Cost of capital coming down, business expansion means more money going to a lot of publicly traded companies for goods and services, in addition to individuals getting more jobs, which will bring unemployment down and employment up. All good things for the economy. It's a sign that the economy is going to be strong. Now, if the Fed, a lot of people feel if they cut drastically, it's going to be because we go into a recession. Now, the number one indicator of a recession is unemployment. When unemployment historically since 1948 goes up by 1% or more, we tend to go right into a recession, or the unemployment increases into a recession. Unemployment dropped 0.2% last month. We need another month or two's data to see if this was an anomaly or if this is a new trend that's establishing. Unemployment was, I think, it was either 3.4 or 3.5% in June. It went up to 3.9% in October. Now it's down to 3.7%. Unemployment has been under 4% for a fairly long time historically. Things are looking very good right now. If unemployment starts to go up, the Fed could have to react quicker and bring rates down. So things still need to play out. Like, there's no guarantee that rates are going to be cut in March, and Jerome Powell certainly did not say that or insinuate that at all. So I want to be very clear on that. But it is very bullish for the market going forward, and one of the biggest reasons that's overlooked, and it's helping SoFi right now, even though SoFi's exposure may not be as much as other companies, it's more for the regionals. You have roughly 1.7 trillion coming due in 2024 and 2025 on commercial real estate assets. The regional banks are the largest lenders in that cohort of debt. The big fear when the Silicon Valley Bank crisis happened in March or April was that rates were going to be higher for longer. Commercial real estate companies, REITs, private ventures, whatever you want to call it, would not be able to pay their bills. They wouldn't be able to pay their debts. The profit models that they built would be useless because they did in a rate environment that was so low that it wouldn't work. They would have to hand the keys back to the bank. When the bank would take these assets on, the fear was that they'd be taking on unwanted assets that they have no proficiency in running. They would have to sell them for pennies on the dollar and recognize large losses on their books, which would bring their book value down and basically really hurt them, possibly cause some of them to go under, depending on how underwater the loans were. With the commentary out of the Fed, this looks like less of a problem now because as rates come down, with that debt being maturing over the next 2 years and rates coming down, it's much less of a problem than it was 2 months ago. Right. So that made the financials rally pretty hard. And SoFi is getting a tailwind from that because it is grouped into the financial sector. They have some exposure, not nearly as much, but it also helps for personal loans and everything else because you can say that when carrying costs for credit cards and everything else comes down, it's easier for people to pay back money. So you could have less loans going into default, et cetera, et cetera. So it is a positive for SoFi.
Yeah. Go ahead, Tevis. Not only that, all small caps ran high growth names, high risk names as the market was going more risk on because, I mean, Fed holding rates where they were, even though Powell was more hawkish earlier on in the year, he needed to project that hawkishness, but it basically confirmed, okay, we're not going to get any more hikes. That would be silly. And we know the Fed sort of hiked even more than they probably should have with the limited data they had available. Tanner, if you can just throw up my screen. This is the dot plot around the latest meeting on December 13th. And the bigger validation for the market was really those cuts, this consensus around us having 3 to 4 cuts in the new year to essentially bring rates down to that mid 4% range. Now, an interesting thing you said, Steve, was not knowing necessarily whether they're all going to be 25 basis point cuts or whether they're going to be bigger cuts. I personally think they're all going to be 25 basis points all the way down, but this sort of paints a pretty clear picture of how those rates might play out over the next 2 years. And that really just gives the market more permission to go risk on and make a strong argument that they're going to be able to capitalize more on returns in equities as opposed to returns in treasuries over the new year. And that's why, I mean, SoFi, like, it might have gotten a tailwind from financials, sure, but it definitely got a tailwind from having a high growth multiple because all high growth names essentially in a lower rate environment are going to see a lot of that capital that's flooding back into the markets.
Yeah, I mean, and I was shocked that it grew. So December 7th, when the new numbers came out, and it jumped from 5.7 trillion to 6.1 trillion sitting in money market accounts. Now, let's be very clear. And I am somebody that has a CD ladder built, okay? Money sitting in money market accounts is so much different than money that is in CDs or T-bills because CDs and T-bills are a fixed amount of time duration where you get penalized if you need to touch that money. A money market account is completely liquid. You can move that money at a moment's notice. So when you have 6.1 trillion sitting in money market accounts, that's money that these investors move there to generate yield because they're unsure or they want income, but they don't want it bad enough to lock it up in a fixed duration. So you got to believe that a decent amount of that's coming back into the market when the Fed starts cutting rates and the yield on the money market accounts come down. And if they're just hanging out in money market accounts, and this is my own personal thesis, is I look at myself. If I had money that I wanted to invest in tech, there has been multiple, I mean big tech, there's been multiple times to get into it in 2023. They have not done so. It's been sitting on the sidelines. When this money comes into the market, I think it's going to do two things. It's going to go into income producing assets, dividend stocks, probably dividend aristocrats and dividend kings will get a bid. I think REITs will get a bid. But I also think they're going to look for high beta and they're going to look for growth companies to do a catch-up trade. I don't think the money's going into Amazon or Google for a catch-up trade. I think it's going to go into SoFi, Robinhood, that type of stuff for a catch-up trade because they're going to want to close the gap. And I don't think you're going to get that from big tech. I actually think you're going to see, and this hurts me because I have investments in Amazon directly, Alphabet, Apple, Meta, and Tesla. And I do think a sector rotation is going to occur into other areas, and we're going to see a broad rebound in the markets because there were a lot of areas that did not necessarily do well or certainly did not keep up with tech. Now, I do think tech is going to have a good year next year. I just don't think it's going to replicate 2023. I do think you're going to see double-digit increases in these names, but certainly not what we saw this year. I think that you're going to see a lot of these other sectors catch a bid, and these growth companies could definitely see capital come in because I think people are going to look for the most bang for the buck on it.
I just wanted to add, I've got a couple things right here. One, I completely agree with you. What?
Koifin?
Wait, just hold on a second. Don't spoil it, please. One, I was saying this on my channel on the Fintech Frenzy as well. I think that there's a super drought right now in some of the small to mid-sized cap stocks, and that there will be a rebalancing back to normal, which will lead to outperformance in some of the smaller names. But I don't just want my opinion on this. Ladies and gentlemen, I'd like to introduce you to Danny Deals. Danny.
Hello, everybody. Hello and welcome. Welcome and hello and welcome. Thank you for having me on. Tanner, it's an honor. Steve, an honor to meet you. And Tevis,
Nice
an honor as well.
Nice to meet you.
Actually, I'm the guy, as you know, who called you and Amit dildos some time ago. I've always been a huge Steve fanboy and also a huge Tanner fanboy, but actually been watching
huge
Tevis'
fan of you, Steven. Not
been watching Tevis's channel a lot now, and I'm a Tevis fanboy, so I'm just I'm a big fan of all three of you guys. Thank you for having me on.
Danny,
I tend to monopolize the conversation, so I'm going to try to be quiet a little bit.
No, man, people are going nuts right now.
Oh, Matt Flo, yeah, I love these guys, man. The Turd Army, all these turds watch my show. I don't even know what I'm talking about. Like, my channel was a reaction to why I love Tanner, and Steve blows me away with when I found out Steve was brought up in country clubs, I was like, this guy makes sense. He has such an ease with money, such a sense with money. He's not all panicked and hyper like a teenage girl meeting the Beatles. It's data. It's data you get. I give people no data. I'm like a comedy guy.
Look at it. He loves to take a good compliment. Look at him.
Yeah. No, I mean,
why are you doing that?
Just ignore him, Danny. He's playing World of Warcraft in the background. So
no, I know.
I am not.
He's my Sam Bankman feed. He's so smart. He's smarter than everyone else, even using 5% of his brain power and 95% just decimating his enemies in virtual worlds unknown to the rest of us peons.
So,
but anyway, thank you for having me on.
Thanks for coming on, Danny. I appreciate it. People are out of their world excited right now.
I love these guys, man.
Okay. Let's talk a little bit of SoFi, but we were just on a macro conversation, Danny, and I'd love for you to dive in here with us. What did you think about the latest meeting? Why do you think that this is such a large impact to SoFi? And do you have any predictions, expectations? What did you think over the last couple of days where SoFi has kind of been running up in stock price?
Tanner, I did a lot of soul searching since Fed Jerome Powell came out, and I dug deep and I questioned a lot of my assumptions, and I'm more bullish SoFi than ever. I mean, the entire bear case that the likes of the Chia Pet and the Five Head from Compass Point assembled against SoFi all relied on this theory that we're going to have a giant recession and it's higher for longer. And even though SoFi's borrowers are of extremely high quality, they're eventually going to start to default. and they're sharing the risk on these, gain of sale agreements with the likes of BlackRock and these other, organizations. They're laying off some of this loan. It's such a small, when I hear about the bear case, it's loans and it's macro. Okay, 90% of the bear case just fell apart. I mean, what is SoFi doing poorly? I saw you talking about the credit cards. That's a legitimate issue. I mean, I'd be the first to say there are legitimate issues that SoFi has to address. But if you take an honest, holistic view of what this company has accomplished and the management and the business model and the fact that the business model has not even had the opportunity to work. I mean, first you hit it with COVID, destroys their whole, Tanner's heard this spiel before, but it's for the rest of you guys. They hit us with COVID, they reinvent the entire business, grow at a very steady, controlled rate. I don't know. I'm sure you guys know how hard that is. You see companies like Affirm and Robinhood, they're all over the map. SoFi is just dialed in. Noto's a finance guy. The guy inspires confidence. He's an all-American mechanical engineer, top of his class mechanical engineer. I could barely remember what you asked me, Tanner, but as far as the macro goes, why is it so important for SoFi? Because there's a massive short on the stock, 144 million shares. And that entire short is based on smoke and mirrors, hints, innuendo, and things left unsaid. These guys come out and they go, can you believe a guy like the guy from Wedbush? He comes out and he used a bit of legalese at the end of one of SoFi's ERs. It's something the lawyers, it's a throwaway line. Like, I got a family full of lawyers, my older brother. Like, I know when a lawyer writes something, it says, well, if our entire business model goes bad and if we have to raise money in an unfavorable, and he put that in his note. It's a throwaway legalese boilerplate line, Tanner. Tevis, help me.
I wanted to
look.
I'll let you guys. Like I said, I monopolize the conversation. That's why I'm no Amit, guys. I can't replace Amit. Nobody. Tanner's top left now. I'm bottom left.
It's hurting my brain.
I don't even know what's going on.
Keep it like this. Keep it. We gotta break the OCD.
So there's
a lot of. I'm on a lot of meds, Steve.
There's two things I want to pick up on. Okay. Number one, with regards to Cavarini, I mean, he reiterated his, or was it Compass Point? Either way, one of these guys reiterated their point literally after Chris LaPointe cleared it out. And he highlighted a point that Chris LaPointe 24 hours before cleared this through. So it's very clear that they weren't listening, or at least even if they were, they weren't paying attention or understanding or retaining anything that was being said.
To be fair, and I'm not sticking up for any of the bears, but to be fair, banking is a little bit more complex and complicated than other sectors of the market. And I'm going to leave it at that. I'm going to be nice.
Sure.
Okay. So
I would be the first to say, like, a guy like Chiavarini has decades of experience. He knows infinitely more than I know.
He doesn't. He does.
He does. He does, because Tevis, you're giving him the benefit of the doubt, saying he's wrong. He's not wrong. The calls coincide with a short attack. The guy reiterates 5 times in the course of 8 weeks. Right. No professional analyst does this. Other guys are coming out quarterly, making their calls. This guy reiterates downgrades, then he does fake upgrades. I mean, I'm not a conspiracy theorist, and I do understand that I don't understand, the intricacies of the banking sector. But I do think some of these guys are not mistaken or misguided. I think they're actually dishonest. That's my opinion.
I would say that they could make a better bear case, one that holds more water than the points that they used, for the simple fact that the points that they used went against everything upper management said.
Right.
They could have taken a different approach to making a bear case that would have made more sense, but they didn't.
Well, I mean, there's bear case that makes sense, but it doesn't grab headlines. I mean, what grabs headlines in a high interest rate environment is defaults, panic, defaults. And, people are seeing their adjustable rate mortgages go through the roof, and it resonates and it gets through. And I mean, you remember the last time they hit it from 650 at the ER, they got it all the way down to the 4s. they're able to knock 40% off the stock, and I just don't think all this stuff is coincidental. I mean, I've gone into like Chiavarini's background, and he is not dumb. He's a very smart guy, very well educated. I mean, he knows this stuff. He knows when he's saying that, SoFi's worth $3. That's basically like next year's sales on a company that's growing the top line at 35%, that's going to get to 20% net margins. And the tech side is worth nothing. 35% growth is worth nothing. You have faster. Steve is my bank deposit guru. I actually study that chart he puts out of 100 banks. I mean, those are hard numbers. I mean, I know I don't get what's behind all those numbers, but I do see the numbers, and I do see the deposit growth just through the roof.
So let me pick up on something you said, because it was a piece of news this week, and I'd love for us to chat about it. We got the short interest, the highest it's pretty much ever been on an aggregate basis. 143 million shares sold short as of November 30th. This is coming, we found out this news on December the 12th.
This is both percentage and in millions. It's 142.65 million right now. And I can't see it on my screen because my camera's cutting off. I think it's 14 point.
It's like 14.6% of the shares are sold short and 15.5% of the free float.
So, okay, let's say 15%. This came out on December 12th. And interestingly, SoFi rallied like 20% after this news because of the FOMC meeting. This is going into the quarter that's going to be the tipping point from a profitability perspective and expected forward guidance for full, profitability from this point onward, sustainably profitable. And yet we're still increasing in the level of short interest. Is it just people think we're trading in a channel and we're going to fall back down to 6, or like what is the thought process?
Okay, well, I'll just say, one, being so fundamentally driven, not following a lot of technicals, I find it hard to believe in some of these channels. I think the channels work until they don't. You know what I mean? And it's hard to know whenever they're going to stay that way. So no, I don't think that we just continue to go back down to 6 and up to 9 and have this cycle continue while breaking into new milestones like permanent contribution profits, net income going forward, potentially 4 quarters of profitability going forward. This changes the way companies look at this stock, right? Not even just retail investors, but institutional investors. That's the people that really need to start pouring into SoFi. It's not retail that we have to convince. If you actually look at the percentage of institutional holdings and then the percentage of shorts on SoFi's company, it's like 25% of this company is owned by institutions. If you compare that to any other bank or fintech or anything like that, it's so unbelievably low for the sector. Okay.
And a lot of those are short long.
Yeah, but there's a lot of reasons why that is also. It's not a part of total market funds. It's not a part of S&P fund. So it needs to get certain metrics, and then you're going to see institutional ownership increase drastically because it'll meet the criteria to be part of specific funds that have the largest amount of AUM.
Yeah, but even then, like look at the S&P 500, inclusion effect. It doesn't make the stock double, right? It's an increase in the stock and potentially on a permanent basis whenever you get included into these funds, but it doesn't double your market cap. Like the effect is real,
but it helps with short attacks, certainly.
Sure. So I want to pose this question to you guys really quickly. Do you actually think that a short squeeze is possible in a stock like this?
Yes. This is This is what I wanted to also touch on, because Chris Hager, I think, made a post on X saying that the liquidity of SoFi is so high, and to the point where a 15% short interest is not enough to trigger a squeeze. I personally think that there could be a squeeze for sure.
That's not the way to look at it.
Okay.
A short squeeze, it doesn't matter if it's 5%, 10%, 15%, or 30%. What matters is if the shorts are underwater and if it looks like their short position is going to close out underwater, because they will lose less money if they buy it out and close it before the expiration date. So it matters what the average short got in at, where the stock is now. If they're down, and hypothetically, let's say they're down now, SoFi is going to report end of January. Chances are that SoFi is really, and I can't predict the future for shit, but I would say that there's probably a low probability that SoFi is going back to 7 before earnings, especially with the news that we just got out. So if people were shorting this stock at 850 or so, they're going to have to cover. And yeah, they can roll the dice, but going into a quarter where SoFi has not warned that they're going to miss profitability, it probably wouldn't be the best idea to hold a short into this earnings if you're underwater going into the earnings. So you could certainly see a short squeeze.
Yeah, and in fact, management has doubled and tripled down on the idea that they're going to be profitable this quarter, right? They had a meeting this month talking about how they're going to be profitable in Q4. So I don't think they're going to miss it.
So basically, if I can summarize, Steve, you think that there's basically a deadline up until shorts need to cover. Otherwise, profitability is such a done deal at this point, and a rally is so guaranteed from profitability, regardless of how priced in it is, that it would spell a bad time for shorts if they don't cover by that time. Is that basically what I'm hearing?
Yeah, I mean, look, there's two ways to short. You borrow shares in a short, or you can buy puts. And puts roll off every week with this company because there's weekly option chains. So it really depends on several factors. But the really short answer is, depending on what price you purchase your short at or what the target price is and the spread between it and if you're up or down. I mean, look, if people went on a very long short to maximize the delta between the two, there's a halfway decent chance that they're underwater right now. And look, when SoFi ran, what did it run to last earnings? 11 or 12? People may have started shorting that. So let's just hypothetically say people started shorting at 11. You're starting to get back to 11. If SoFi runs up to 11 in the second week of January and it doesn't come back down and you're going into earnings, people are going to close out their short positions because if it goes to 13 or 14, they're going to owe the difference. So people are probably going to cover in those scenarios. Now, I don't know how to figure out, based on the data that I have, what all those different scenarios would be. But, I'm going to try to figure out where these shorts bought everything. I don't know what program I can use to do that.
So there was always a short, a sort of core short on SoFi, 70, 80, 90 million shares. But if you look at the short interest, it actually went from 90 million to 160 million shares on loan after the pump and dump, after the stock went up into the 11s. Like a lot of these guys were shorting extremely heavily at 720, 740. I mean, there was days where they were borrowing 8-10 million shares, I think expecting to drive the stock back down under 6. I think they were expecting a really bad earnings report driven by the macro, driven by defaults. And I think they got a huge October surprise. And now, I mean, I just think they're completely trapped. I don't think they have an exit strategy. I think the smart shorts who were long-term, would have covered down in the 4s. I mean, were they expecting to drive the stock and down into the 3s? I mean,
yeah,
I just you're going for absolute zero. I think now you're in the mid 9s, and I think a lot of the shorts are deep underwater at this time.
This is not a good company to short because the littlest news.
Let me ask you guys this, because I heard it from both Steve and Danny, that like this underlying assumption that when you're shorting a company, you're doing it over some longer time frame, sort of like a swing trade. I mean, the pieces of information that I'm operating under is that, hey, 2 weeks ago, we were at 142 million shares. I don't really have an updated number that's more recent than that. And
I'm pulling it up on the screen.
Okay. And the second piece of information is that SoFi did a 20% run this week. And I guess my biggest question is, what percentage of those shorts would have already covered at this point?
Nobody covered. None.
Hard to tell, right?
I
mean, you don't know if people are if they're doubling down. Like interest continues, or as a percentage of outstanding shares, the percentage of shares continues to go up. Like it's at all-time highs now. Either they get buried or they really think that SoFi is going to get trapped. I don't know what their decision will be, knowing this new, not rate cut decision, but sort of rate cut hint, right? Saying that it's going to start turning. That could potentially put some of these shorts on their back foot, but doesn't necessarily mean that they give up. I don't know.
I mean, what doesn't make sense is that we were down to 11, almost 12% being short September 15th, and we're back to over 16%. Like people have been shorting it into this run.
Yeah.
Well, so if the assumption, just as Danny said, is that nobody is covered so far, then we're still sitting at these record levels of short.
Well, it's not record levels. I mean, it was over 20% short in 2022.
Yeah.
Well,
the highest in a year.
On an aggregate basis.
Highest in a year, yeah. I mean, we're back.
It's higher. It's just gone over where it was on June 28. It just went over that level. So
yeah, exactly.
And what they're doing is they're basically like yesterday they returned 7 million shares at the beginning of the day. And it looked like there was just going to be this wholesale covering. And then after hours, they borrowed the 7 million shares back. So as far as I can tell, I look at probably, 3 or 4 of the most prevalent sites that you can pay a membership to and look at as updated as they can get the short interest. I assume those people collecting my money are a lot smarter than me, but they are showing nothing returned. They are showing, if anything, the shorts, increasing into this rally. There's been no covering. At least that shows up on anything I subscribe to.
Which does open the door for a very real possibility of a short squeeze if nobody's covered so far.
Yeah.
Wow.
In which case, where do we think... this is speculation, but I guess what I'm curious as to finding out your guys' thoughts is, we're at 140 million plus shares. Where do we think that might fall to? And what is the corresponding price if this does go into a short squeeze situation?
Well, you got 16% of the float short. To close it out, they got to buy the shares. So that's just more liquidity going into the stock. And if you even get anywhere close to half of these covering, in addition to other people buying, this could, I don't want to get ahead of myself, but 12, 13 going into earnings, maybe?
Hit your end of year price target, Steve?
Look, I don't think it's going to get there.
Right?
I really did in the beginning, but when we hit 10 over the summer. But look, I think that SoFi is going to have a really good year next year because I think a lot of things are going to go right at the same time for the first time ever in the company's history. And I think we're going to have a very good year next year. I could be wrong, but unless something goes really wrong, there's a lot to be bullish about going forward.
SoFi's business model is going to start to work well as rates come down.
Yes.
I mean, we own the student loan refi market. Those borrowers have money. They have great careers. They're young. They're only going to be making more money over time. They have average 785 FICO scores. Their scores are even far higher than other SoFi borrowers. So we already own 60% of that market. Discover just announced they're abandoning ship because, they can't make a go of it. They're weak-kneed, paper-handed fools. And, Commendatore Noto is not afraid of taking on that business because people don't want the business because it doesn't have a great margin. But our business model is just come on in the door, welcome and hello. And And now we can sell you 5 other things because these are upwardly mobile people with PhDs and law degrees and MDs. And this is just absolute gold mine long term for SoFi. Noto is so many moves ahead. He's ahead of the Fed. He's ahead of all these other executives. He's certainly ahead of the 5 head. But I mean, I don't mean to make light of it, but SoFi has been fighting with one arm and both legs tied behind their back. The fact that this company is even in business, I think it's a coin flip. The company even stayed in business through all this. And to see them like absolutely hitting these doubles and triples every ER in this controlled manner is just inspires so much confidence in management. Guys, I just love the company. I love the stock. And I'm more bullish than I was when I came on the beginning of this podcast, to be honest.
I think that Chris Hager pointed out something recently on Twitter where he said he believes that some of these analyst predictions on revenue growth rates throughout the next couple of years are just drastically too low. They're expecting decreases in revenue over time, but very early. Obviously, this does happen to companies over time, but you're talking about comparing a company that was growing in stronger growth rates back, like with what you said, arms and legs tied behind their back, right? Not having some of their business models there, not having a bank charter before, now
the 19-20% 5-year CAGR is I mean, I think Noto made up that number. So when he hits like 28, 29, he's just going to look like a absolutely perfectly haired genius. I mean, 20%, why? I mean, our growth should be accelerating. SoFi Stadium, I think, is absolutely going to blow up. We have the Super Bowl again in 27. They're talking about adding 1 million new members per quarter. So why would growth decelerate that quickly in the near term? I mean, I really think CAGR will be over 25.
Yeah, and I think, being as close to the company as we are, I mean, from the retail shareholder Q&A and from Chris Lapointe's fireside recently over the past month, it does sound as though management is giving these hints through these little statements like 2024, 2025, we're aiming for 800 to 1 million plus per quarter. And you can extrapolate from that to say over 4 million a year. And then to say, well, our revenue mix is going to be closer to, 50% lending and 50% everything else, or 30, 30, 30 over the next little while. And then you can extrapolate from that to say, okay, what is lending? Let me add a growth multiple to lending, let's say 20%. What does technology platform and financial services need to be to even make up that percentage in the revenue mix? And you can get to some crazy numbers just by doing these exercises, by doing essentially the mental math of reading between the lines of what executives have been saying. But I don't think that a lot of people are doing that.
If you got into napkin math valuations like these psychos do on Tesla, you've seen these guys. I mean, they're like, Tesla's going to build 2 new factories a year every single year from 2021 to 2030. And you're like, well, it's already 2024, and they just put the next factory on hold. They're like, I don't want to hear it. But if you start to do that kind of math with SoFi and you make certain assumptions about Galileo gaining market share, this valuation at under 10 billion, when you really look at what this company is and can be, I mean, I've heard Steve talk a lot about top 10 financial institution in today's dollars, 130 billions. I mean, by the time they get there in 12 years, we're probably talking about a company worth $300 billion. And I think Galileo is going to be spun off and is going to be more valuable than SoFi. I mean, I think people are really, no, sorry.
Please don't say that.
No, bad news.
No, that's like when one of my buddies kept saying that he wanted the U.S. business of Palantir to be spun off. Please don't say that.
The government business, I mean.
Why do you guys think
government business whatever?
The government business to be spun off.
Whatever.
Why do you think they're keeping Galileo as a separate company out in Utah and all the sort of management structure completely separate?
So
is it just a strategic decision?
I have no idea. I just don't want it as a spun-off company
I see.
because the synergies between them and Technesis make something so unique that there's nobody that I have found in the rest of the industry that has the capability that that joint venture has.
Well, right, but Technesis is now part of Galileo, so if they spun off from SoFi, it would still be that two-headed monster.
Correct. But if it's spun off, SoFi won't get all that revenue, and then their tech multiple goes out the door.
Very true.
Like,
I
in
think
a couple
You
of
have a pure
years,
tech company, you get that multiple.
like that. But yeah, but the whole allure for SoFi being a hybrid company plays around the tech platform.
That's
Otherwise, without that aspect, they are a similar financial institution to a lot of these other companies, which is not a bad thing. But this
You know
is
what?
their ace in the hole because they have the potential to generate the back end for their competitors and generate reoccurring revenue from that and make a case of why SoFi should be valued in between a financial institution and a tech company.
I also
Whereas-
like with regards to Galileo and SoFi, the pure, SoFi core business, I do think that to some degree, and I don't know, guys, like check me on this, but to some degree, there has to be this separation of church and state because Galileo is going to go after the major financial institutions. And the closer that they are to SoFi, the financial entity, that's essentially a competitor of these financial institutions. And it would become this thing. Like we already know Galileo has, large financial institution clients. And we know that, we don't know any of the names of these clients. They are reluctant to even say that they're working with Galileo. Their reluctance would be even higher if Galileo was even closer to SoFi.
That's why I thought they would spin off the company, is because as SoFi gets larger and larger, their competitors are not going to want to, feed them dollars. I think that's just my theory, but I think it's definitely correct that there is a great deal of synergy, and we haven't even, we were told about the cost savings from Galileo that really kicks in next year. And we'll start saving the company, I think it was at $80 million a year. And then that'll go up after 5 years. So I'm not mad at having Galileo be part of SoFi. I'm just saying intrinsically, I think people dramatically underestimate the value of Galileo. I think it would be an incredible company on its own. And I'm very happy to have it remain part of SoFi. So
similarly to Tesla, these institutional analysts and the ones that are actually crunching the numbers to get to this, valuation model, they can only, value what they can measure. In the case of Tesla, like all retail is losing their shit over this bot because of the potential. All of the institutions are discounting it because it doesn't have any ARR associated with the company. Similarly with SoFi and Galileo, all retail sees the potential, whereas all of these analysts just see what the number is on the bottom line. And up until the point where Galileo can accelerate their growth rate, accelerate their margins, and accelerate their overall revenue contribution to the mix, then it'll always be discounted by the market. And so I think that is a key factor that needs to be unlocked before we can even start talking about a hybrid multiple.
Can we talk about Tesla for a moment?
No, I want to continue on this. I've been patient. I've been a patient boy.
Are you doing something after where we can talk about Tesla?
Yeah, we have a SoFi Weekly After Hours show every week. Steven, it's about 20 to 40 minutes usually.
It's not every week, but okay, go on.
It is every week. When's the last time we missed one?
Every week.
But I wanted to add to this. I think that it's important. I think there's a third element to the Galileo Technesis piece that has not been fully ingrained yet. That will be a huge part of why it's important that they're with Galileo, and what separates them from everyone else is the bank charter, right? What makes Sutton Bank is that they will host a ton of deposits for fintech companies, right? That alone is another piece of the revenue pie. And I think what makes the trifecta for SoFi is you can go to some of these fintech companies, and this is not necessarily important for the large financial institutions, but it's important for the Chimes, for the, Robinhoods, for all these companies, where you can go to them and say, hey, we'll set up your entire card program. We'll build all the UX, UI. We'll set up everything all on a modern cloud-based solution, and we'll also host the deposits and issue the cards ourselves, right? That's another piece of the pie, and I think that that's important. Separating away from SoFi, I don't know if that gets you that close of a relationship. I still think that the future of finance is in the fintechs, and everyone's talking about these large RFPs, which will bring us a lot of revenue to date. But I still believe that the neobanks and the tiny fintechs are where the clients are headed. And we already have a massive portion of those clients. It's just a matter of them signing up those clients and making sure that Galileo doesn't lose any of them. Like what happened with Current, that can't happen again. We want to make sure that we have a durable solution where we win more clients than we lose.
And
that's for sure.
They build their walls around their castle, that is Galileo, much higher with every subsequent product addition that they add. You know, they added Technisys into the Galileo mix. That all of a sudden creates a unique value proposition that builds a moat, right? They added all of these like buy now, pay later, the cards, the processing, the APIs, specifically all the news that we've been reporting on with regards to Galileo throughout this year has been, number one, we can only presume, but number one, requested by these large enterprise clients. And number two, builds a bigger and bigger moat around that product offering. And why is that important? Because it increases the barriers to entry so that we can prevent a Current in the future. They cannot leave the ecosystem in the future if Galileo and Technisys and all of these value like offerings combined do something that nobody else in the market can.
Can I say another
No.
sort of out of the picture acquisition that hasn't happened? It actually can't be an acquisition. It'll be a merger if it happens. And I think it's more important than Robinhood. I think that Apex Fintech should become a part of the AWS of Fintech solution. So Apex Clearinghouse that everyone knows about, dealing in all the brokerages, account openings, global, multiple countries, hundreds of clients, doing all of the brokerage side of finance, the part that Galileo really hasn't touched yet, right? It's the weakest part of SoFi as well. So we could potentially look, and we already have acquired a percentage of that company already. 17% of Apex was already acquired by SoFi. So it's definitely in their wheelhouse. They think about it for sure. But the rest of that company could make, so then we could set up brokerage, set up accounts, set up the banking solution, set up everything. I think that literally would be a one-stop shop, AWS of fintech, and no one to date that I've heard has talked about that yet. And I think that would be unbelievable and well worth a merger.
Apex went down again Thursday morning for an hour. Really pissed me off.
I don't believe that Apex went down. I only heard that SoFi.
Everybody was saying Robinhood was down too for a shorter time, but maybe not.
Robinhood doesn't even use Apex anymore. They use Robinhood clearing. They built their own clearing system.
So when SoFi blames it on Apex, it's basically just a bunch of crap.
Well, did they blame it on Apex?
That's what their PR flack were doing. The CTO never comes out and says anything. They never really put out any technical statements on their outages. It's very vague. It's really annoying.
If they blamed it on Apex, then I believe them 100%. Like I'm not trying to state that. I just personally didn't see that, and I didn't see Ally go down. I didn't see what is it, M1 or Public or any of these ones. So I think honestly, I don't know what it is. I think maybe they're trying to convert over to Technisys and having some flaws trying to get over to a new system right now. That's just
the migration issues.
Yeah, I don't know.
Just before we go into an Apex rabbit hole, can we cover one more piece of news that we saw this week?
Yeah. With
regards to the SoFi at Work partnership, it's smaller, but I mean, we only have 6 minutes left.
Sure.
Tanner, do you mind throwing the PR up?
Did you post it anywhere?
Fine. Yeah. Okay. Hold on. I'll
very important piece of news, because SoFi is going to break into that benefits.
Yep.
I mean, this is like an acorn this is a really important story, Tevis.
Okay. So let me sort of, I sent it to you in the private chat, Tanner. Just open the PR Newswire. So SoFi at Work announced on Monday or Tuesday, I believe it was, a partnership with Kimley Horn, this company that I'd never heard of before, but apparently they have 8,000 employees and over 100 offices, where essentially this company is offering their employees 8% of their salary plus bonus for student loan repayment. And so it's sort of this three-way partnership with Kimley Horn, who is offering this benefit to their employees that is powered by SoFi at Work. And then the third prong is T. Rowe Price, who is the provider of these 401ks. And so essentially what's happening is if I, as an employee at Kimley Horn, pay off $2,000 in my student loan, SoFi's verification system, so around the third paragraph to the bottom there, Tanner, SoFi at Work highlights how their verification system works, where basically it's going to detect that I have paid off a student loan or I have paid off an amount towards my student loan. That's going to notify my employer, and my employer is going to match that amount in my 401k. So while I'm paying off my student loan,
a 200% match. So if you do a 4% contribution, they'll add 8% on top.
Right. So essentially the concept is as I'm paying off my student loan, it's as though I am investing in my 401k as a result of this employee benefits program offered by Kimley Horn, which is really cool because it all hinges on SoFi at Work's ability to detect this repayment and essentially act as
this part here is the exciting part, is that this is now being allowed as of 2024,
right?
Which evidently this student loan verification product is very new for SoFi. They recently just came out with this, even after the moratorium had been resolved. So very recently. And now this is them coming to work already. And T. Rowe Price, which is kind of exciting that they're a part of this, they're also a client of Galileo's through the Waysaver program. They're creating an employee benefits card, right, through Waysaver, and it's also powered by Galileo. So you're seeing this a lot. They're doing this with Experian, where Experian is offering all of our insurance products and also a product or a client of Galileo. You're seeing it through T. Rowe Price, and I'm sure there's going to be tax programs or whatever that start coming out that have H&R block coming up because that's a client of Galileo, or I could see a card program from Expedia coming out that's also powered by Galileo, because they seemingly are, if I were to guess, giving preferred pricing to these clients.
Well, even with a SoFi and T. Rowe Price partnership, which I mean, T. Rowe Price highlights SoFi at Work on their website as well. Just that alone, the network effects are so large, and this benefit is so captivating for these employees because it knocks off, two birds with one stone, so to speak, that as it starts to ramp up more in 2024, it could become a really lucrative opportunity for growth for SoFi. Yeah.
Kimley Horn has been named one of Fortune 100's best company to work for. I don't know if you guys saw the list of benefits that they have at their company. I don't know where it was.
Sorry? I don't know how you get these jobs, but it's incredible.
Here, let me bring this up, and then we'll transfer over to the thing. This is just one little piece in their massive benefits program just down here, student loan 401k matching provision. But yeah, they are stacked and happy employees. From someone that really doesn't have benefits, it's like, ooh, tasty.
Self-employment tax here in the U.S., it's like, if you're smart, you stayed in school and got a job in tech, not do anything else.
Yeah.
Running your own business is tough. Just tax you to death. Better off letting these guys pay your taxes and getting that 8% match. I mean, I've never heard of things like this, but I guess if you're very talented in this world, they have to do whatever they have to do to hold on to you.
Right. Yeah, no, I've never felt anything like that.
Me neither.
So here.
And it kicked me out.
Ladies and gentlemen, thank you all so much for watching the SoFi Weekly Podcast. Danny Deals, thank you, my friend.
Thank you for having me on, guys. Really appreciate it.
Now, can you remind us of your channel name? Because it's so unbelievably long. I hope you change it.
No, I never will. Unfortunately, I don't want that many viewers. My viewers are a complete pain in the butt. But it's Hurricane Lopez presents Un Poco Moss. You could just search for Danny Deals and SoFi. I mean,
that's how I
it's
search
a bad name. But
Danny,
when I made it, I only had one. I think I had 2 subscribers, and I didn't really think anybody was going to watch. And now, a few months go by, I have like 2,000, and people are watching and criticizing, and my production values, my hair, my weight issues. It's open. It's open season on Danny Deals out there.
Danny, are you gonna stick with us for another 20 to 30 for the members only?
Oh, guys, I got to actually eat some dinner. I just came in, just jumped in the door and was cooking and jumped on this. If I don't eat every 90 minutes, I could collapse, just go into a complete diabetic shock. So, plus, I think you guys you've had enough of a dose of Danny Deals for one evening. It's better in small doses, they tell me.
You're always welcome.
Hey, thank you guys so much. I really enjoyed it. Sorry I tend to talk so much, but personality plus, right?
Yeah, man. We appreciate you or having you on, and we'll see you probably one of these other episodes.
I appreciate it, guys. Have a great night. I love your show. I particularly love this show. I'm really getting into being a fan of Tevis's show, and I never pay for anything. I hate all these guys with Patreons. Oh, I can't stand these guys. But I'm going to give Tanner that $5.
I was gonna say, everyone that wants to pay me $5, come over to the
actually
show
earns, and I'm gonna make it $5 Canadian, so he can spend the money.
Yeah.
Like, what is he gonna do with the sawbuck?
Everyone,
what are you gonna do with the sawbuck?
Can't do anything with it.
Going to a Canadian Starbucks, they're gonna go. It's not pretty. But anyway, guys, sorry I ramble on. Thank you so much. I really appreciate you. Love the show. I'm a huge fan, and it was an honor to be on.
Bye, guys.
Thanks.